do the following to make your long-term bond investment sustainable and generate sufficient passive incomes that are material, meaningful, in that they can support you in the long run. Number one, open and operate an investment account or a brokerage account. The greatest mistake of all time that most small investors are doing is that they are electing their settlement accounts when it comes to the bond market or the CSD settlement account to be their ordinary bank accounts, their saving account, meaning that once the bonds are redeemed, once the coupons are paid, they are landing into your ordinary account, checking account, meaning that that risks that money into being misappropriated or being used for other uses apart from investing. Investing for the long term is a dedicated investment, a dedicated setting aside of money regularly into opportunities, looking forward to a sustainable passive income in the long run. And therefore, this investment must be protected against any form of predatory destruction. Number two, know the 72 rule or Rule 72. Rule 72 helps you to determine quickly the number of years or investing years that it will take in order to double your money. This Rule 72, we use it in compounding for a quick mental math. For instance, if I'm investing in an opportunity that is giving me a fixed return of 12% per annum, it simply means if I take 72 divided by 12, it will give me 6, which is the number of years that it will take me without adding any other amount for that amount of investment to double. Meaning that if it is a million, it will take 6 years for that million to become 2 million. And what does that require? Number 3, compounding, dedicated compounding of that investment. Compounding is a process, a dedicated process whereby we are not withdrawing anything from our investment account, from our brokerage account. Anything that is paid back to our investment account is purely for investment and need to be invested immediately. Remember, in the bond market is very flexible. The government will not float one bond or one treasury bill. It floats several. So in that case, you will always have the option choosing from the options that are given. And dependent on your investment term and your Rule 72, the number of years that you have elected would be your doubling years, then you will be able to choose. And this means then, because we have a dedicated investment account or redeemed capital, and any coupons paid are going to be dedicated back to another bond, a treasury bill, or any other form of investment. And all our investments are bringing back the return and the capital to that account. It has always been said that do not cut a tree, but enjoy the fruit and the pudding. Use the seeds from the fruit to propagate a forest, because if you cut down the tree, you have stopped future generation of fruits. The same with the capital. Don't touch the capital. You only need to touch, if need be, the interest or the return. But in this case, we are saying that there is a seed in every return. there is a seed in every fruit, and that is capital. So when we pull back the returns back to investment, that is what compounding is, because the returns start generating other returns. The rule 72 will effectively apply in compounding, where we are not redirecting the returns. The returns are getting back into investment in order to stick to our period of repayment. Then, the worst detractor, the worst destroyer of our investments is disease and education. The fastest way to become bankrupt is by way of disease. You must have seen diseases, families that have been bankrupted to poverty because of a disease. For this reason, for our long-term investments, we need to take an action to create a security investment or an insurance or a fund that cushions that investment against these detractors or destroyers. A disease strike, you need to have on the side an insurance product that protects this investment against diseases in your family. A good example is the NHIF, the shift, pay, always subscribe to these medical covers, because so long as when your sickness strikes in your home, that risk is taken by the insurer, it protects your investment against destruction by that disease. The same with education. For the long-term investment, you need to have another investment that ensures that the children will be taken care of. Remember, the long-term investment, we are cushioning it because we will need it at the determined period of time. Then a time frame is the next one, number 5. Our investment is a goal has to be time bound. We know when we want to retire. We know when we want to start enjoying things that we like doing. We know when we want to go doing our job because we love it, but not because it is supposed to pay our bills. So essentially, the reason why we are doing this investment is in our active years, generating active income, and we know that there is an inactive time where we'll be not able, or we choose not to, we want to do other things, then we need to put aside and invest so much for the period that we choose, so that by the end of this period that we have chosen, the investment, the portfolio that we will have built will be generating sufficient passive incomes that can sustain our lifestyle that time, and because of protection of the capital for the longest time. Number 6, save and invest excessively or expand your investment. In order to achieve our target goal or target investment quicker and fastest, we need to expand, keep on putting in towards the investment, and that, because of compounding, shortens the period for our goal, because the longer the term, the uncertainty the period. And lastly, enjoy the fruits of your labor. Once you have sustainably built the portfolio and the fruits have started coming in, enjoy the fruits, because the tree and the forest is intact. And that brings a sustainable income to you and your people.